Hey guys, welcome today. This is Tuesday, January 13th, and this is Jeff Wright with Fish Creek Capital. I've got a good one today. This is a tractor company that you would not believe is up 75% this year. Well, for the last year. So I was going to go over that and then talk about, should you buy it now? Is it too late? Is it too early? So we're gonna talk about that here in a second. Let's first just look at the news and headlines for today. The market. Let's go look at CNBC. We are live and unedited, so bear with me here. The market was down. The Dow was down almost 1%, 0.8%. The S&P was down 0.19%. The Nasdaq down 0.1%. The VIX was up just a little bit. Well, to 15 still. It's still right under 16, but it was up 5.6%. The headline CPI, so that's the inflation number that came out in line with expectations at 0.3%. So that was 2.7% year over year. Really, inflation is better, I think, than a lot of people want to admit. I know food prices, at least locally around here, they're a lot. Butter at Costco has gone crazy, especially if you get the Irish butter. It is really high. But overall, inflation is really much better and not going up. So that was a better number than expected. Let's see what else was going on today. Bitcoin is doing well this evening. It is it's up to 95,000. So that's good. It hasn't been we haven't seen that in a while. Let's look here. The futures, Bitcoin futures are showing 96,000. The Ethereum is over 3,300. So Bitcoin, crypto's having a good day and even a good evening. So we've got the tariff announcement is supposed to be tomorrow. If not tomorrow, it could be Friday. I don't really know. I understand why the Supreme Court would rule against those. I just hate that everything is so political, and I don't really understand. But there is a date for that tomorrow, so that there's a lot going on, a lot of headlines, a lot of things happening. I think that's probably all we've got today. So year to date, the S&P is still up 1.73%. So that's 13 days in, halfway through January already. That's hard to believe. So let's look at what tractor company is up 75% over the past year. That is Caterpillar. Caterpillar is the company that's up this much. And let's look. I'm going to go ahead and just share my screen like normal. Let's make sure we've got the right screens available, and we'll just walk through what's going on with Caterpillar, at least maybe why it could be up this much in the last year. 75.59%. So that's crazy. Do you need AI, or do you just need a good solid tractor company? As I share my screen. So here we are, just CNBC. You can see Caterpillar is a dividend payer and a dividend grower. We'll talk about that also. Today, it was up 1%. Even today, $636 a share. It is already, they've got a 0.95% dividend yield, and that is pretty low right now because of the stock price being so high. Year to date, it's already up 11%. That's crazy. Let's look at, let's close that, and I'm going to just go to Seeking Alpha. Again, these are the same tools, just again, not a full analysis. This is just for educational purposes only, but want to just show you, why, how to start looking at a stock like this and what's going on with Caterpillar. So if we just go to the summary page, Caterpillar, knock out some of those ads. They've got great profitability. There's momentum is good. Valuation and growth is poor. And I can show you that here in a second on fast graphs. Again, look at the articles. This is where you can kind of look at the analysis. You can see the news. This is a great tool to go just get a good synopsis of what's happening with a company. And of course, we like going to the dividend page because we're focusing on dividends and companies that are growing their dividends. So they've got good grades. Their yield again is a D. I think understand that because now the stock price is so high, so their yield is lower. Payout ratio is 30%. That again, if you're watching these videos, that's a good number. You want below 50% for sure on a payout ratio. That's the cash that the company is using to actually pay the dividend. Dividend growth, 32 years. That's pretty awesome. Let's look at that dividend history. 32 years of dividend growth, 36 years of a dividend payment. So that's pretty awesome. I love that. And then let's just go to the scorecard. Well, let's look here at the growth because I'm looking for the 10-year growth rate. That's what we like to look for. 3-year, they're 8%. 10-year, they're at 7%. So that's pretty good. So if you take a 7% growth rate on a dividend, even though it's a low yield, and then if you would have taken the last year of Caterpillar, you would be up a ton, and your cash flow would be growing also. So that's what you want to think about when you're nearing retirement or saving for retirement. You want to think about what kind of cash flow you're going to have at retirement. Like that's the whole point of retiring, right? Like how are you going to pay for retirement? That's why we love dividend growth. That's why we love dividend growth portfolios, because they're more predictable. They're often less volatile, and you can show what your income, or not predict, I don't like that word, but you can go out into the future and see with calculators. We've got a growth calculator where what to expect at least for your cash flow, especially when the dividend is growing. And there are companies like this that are just producing cash hand over fist, right? So love the numbers here, 7% growth rate for the last 10 years. Of course, we don't know what's going to happen in the future. Again, this is just informational purposes only, but if we can take a 10-year history of data and project out what might that look like in the future, that's a much greater plan in our mind than just, guessing or hoping or gambling. Often what you hear with the stock market, this is the exact opposite of that. We're using data to actually, this is real data on a real company, and we're showing what your future growth could look like and future income could look like. So that's why we want to go to Seeking Alpha. That's why we want to look at fast graphs. Let's go there now. So if this stock is up 75% for the year, this is real important. Again, not investment advice, informational purposes only. But you can see, look how this stock has just shot up 11% already up this year. And again, on fast graphs, if you've got a good company, and if it's had an event is something that Warren Buffett likes to talk about that would cause a company to go on sale. The business model hasn't changed, the cash flow hasn't changed necessarily, but there's been some kind of an event that would cause the company to be on sale. Like if we can get a strong company and we see the price down here in this green area, at least the way fast graphs is displayed, that is what you're looking for. You can see, so it was down here like 2019, 2020, of course, everything went up. We're back down here in 2022. And then look, just in March of 2025. So we've seen that 75% in the last, not even, in 10 months, I guess. And it was down in this green area, had a 14 PE. That's the price to earnings ratio. So that would have been a good price. Like you can see the fair value is around 15. The normal ratio is 17. That would be this area in between the the orange and the blue. So at best, you're wanting to buy in this area. Again, if we can get below here, that's a better price. But look how it has just shot up. So now we're at a 33 PE. I'm seeing that over here on the right, 33.9 price to earnings ratio. So it is double over the fair value ratio. Even the normal price to earnings ratio, it's double. You can see down here with the projections that because of that, you would estimate based on the forecast with fast graphs anyways, a negative return, a negative 11% return if you bought Caterpillar at this price. So that's why price does matter. You just don't want to go out and buy anything at any price because it can dramatically change your return, even a dividend stock, even a dividend growth stock. Like who would have thought Caterpillar would have been the one that was up 75% last year? So if you buy that right now and you go back to the normal PE of the set of 17, yeah, you've got a negative 7% return based on that, which kind of correlates to what they're saying down here with the earnings forecast. So let's look though, if you would have bought it down here in April of last year and then forecasted out to even the normal ratio, you're at a 16% annual return. And then if you bought it down here and then you rode this high, you've got, if you were to keep that going, that would give you 186% return. And again, that's skewed because of the way this is just so overpriced right now. So again, not investment advice, but you don't really want to buy Caterpillar right now. It has been on an incredible run, and I love these graphs because it clearly shows you this. That's why I like sharing my screen and showing you what I'm looking at. Why would Caterpillar be up like this? Well, you don't necessarily need an MBA in finance to pick good companies. You want to pick companies that you can understand. I can understand tractors, people buying tractors. I can understand, easily look at their financial statement and their earnings report and understand this business. You don't need a finance degree for that. You do want to be able to look at some normal financial statements, a cash flow, income statement. You want to build a balance sheet. You want to be able to learn how to read those somewhat. But the main reason, not the only reason, but one of the reasons Caterpillar is up so much is because of the tax laws that are in effect now with the new presidency. This last year, they brought back 100% depreciation, and you can write off capital expense now, equipment, 100% in the year that you buy it. So that's a huge tax advantage. That's one of the reasons, and I would argue one of the main reasons why Caterpillar has done so well. So yeah, that is often a way that you can look for good investments, is to pay attention to the news, to look at the tax laws, what would be affected by good changes in tax laws. And in this case, it's what companies would benefit from 100% depreciation. Caterpillar is one of those. People are going to be buying equipment right now. People are going to be buying tractors. People are going to want to do that and get that tax write-off. So yeah, that's something that's kind of common sense, I guess, but you might overlook or you might not think about. So I would argue that that's one of the reasons that has just driven Caterpillar stock up so much and why it has done so well in the last 12 months, something that you normally wouldn't necessarily see with Caterpillar, right? So I hope that was helpful. Again, just kind of walking through, okay, how to look at a stock, how is it priced? You can see that again here with fast graphs, looking at the dividend, which is what we like focusing on here at Fish Creek. And what may or may not be good about that, just high level with Seeking Alpha and being able to pull this information. Again, these are all tools that you can even use for free, but this is not investment advice. This is for informational purposes only. If you need help with your portfolio or want to talk about what your portfolio looks like, please reach out below. Would love to talk with you, would love to help you. You can click and schedule a free appointment with our appointment with the link below in the description. Leave me a comment. Let me know what you think about Caterpillar. And did you know that it was up so much in the last 12 months, that it was up 11% even this year, and that it has just been a straight line to the right? So thanks for watching. Please like, subscribe, and we'll catch you on the next video.